Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Teladoc stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Teladoc is a telemedicine and virtual healthcare company. The company's services include telehealth, medical opinions, analytics, telehealth devices, and platform services. The company uses telephone and video conferencing software as well as mobile apps to provide on-demand remote medical care. It is the first and largest telemedicine company in the US. TDOC acquired BetterHelp in 2015, they acquired Best Doctors in 2017, and Advanced Medical in 2018. In 2020, it acquired InTouch Technologies and enterprise telehealth solutions for hospitals and health systems. Also in 2020, it merged with Livongo. This will help the company improve the delivery, access, and experience of healthcare for consumers around the world. Livongo is pioneering a new category in healthcare called Applied Health Signals, which is transforming the management of chronic conditions. In 2021, Teladoc acquired UK-based telemedicine provider Consultant Connect. This company's specialty is in facilitating healthcare professional-to-professional advice and guidance in the UK. TDOC is active in 130 countries, and it has 52.5 million paying members as of 9/30/2021. The company is headquartered in Purchase, New York, and was founded in 2002. It trades on the New York Stock Exchange, Deutsche Börse, Mexican Bolsa, Sao Paulo, and London Stock Exchange. Let's get started with the model. This is a large cap company, 13 billion market cap. They're trading at $82 a share, and they have 160 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have positive free cash flow in 2019, negative in the other years, because they are investing a lot back into their business through acquisitions and through internal growth. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's negative every year. Revenue is a sales for the company, and that grows a ton from 418 million to 1.9 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that grows from 289 million to 1.3 billion. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue. And below that is their operating income, which is negative every year. Below that is the interest they pay in their debt, and then other income and expenses. These are all the gains or losses not tied to the company's core operations. Below that is your pre-tax income, then your taxes, and the bottom line of the income statement is their net income, which is negative every year. This is their income statement from their latest quarterly report. This shows us the first 9 months of 2020, the first 9 months of 2021, the third quarter of 2020, and the third quarter of 2021. The top line is the revenue, and that grew from 289 million to 522 million. Here's a breakdown of their revenue. A majority of it is in the US. Through access fees, that was 414 million. International was 38 million. Access fees are the subscription fees that each client pays. It's similar to paying your monthly insurance premiums. This gives customers access to their doctors, their chronic care management platform, and a whole host of other things. Also, when you have a call with a doctor, you may have to pay a visit fee, and the fees vary based on your situation. They also generate revenue from selling telecommunications equipment. The revenue from visit fees was 60 million. Their other revenue actually went down from the third quarter of 2020. Their subscription revenue almost exactly doubled from third quarter of 2020 to the third quarter of 2021. It more than doubled from the first 9 months of 2020 versus the first 9 months of 2021. Their cost of revenue was 169 million. So that means their gross margins are 68%. The way you calculate gross margin, you can take the revenue minus the cost of revenue, you take that number, and you divide by the revenue. So their gross margin is 68%. In the healthcare information and technology industry, the average gross margin is 52%. So they are doing better than average. I think they're more likely to fall into this category than these two categories. but their gross margins are even higher than the healthcare products industry. We can't look at their net margins because they have negative net income. In a few years, when they mature, then we can look at their net margins. But you want to track these numbers over time. So if you see their gross margins are going up each quarter, that's a good sign. But even if it's high at 68%, if it was 80% at one point, that's a concern. You can't just look at one number and get all your information. You have to compare it to other numbers within the same company and also within the industry, and you get a lot more information. The reason they have negative net income is because they're spending a lot of money. They spent $111 million in advertising and marketing, which is more than double from last year. $63 million from sales. They spent $80 million in technology and development, which is more than double from last year of $30 million. Since they've been acquiring more companies, I imagine these expenses will keep going up. Acquisition expenses, general and administrative expenses, that was over $100 million. Depreciation and amortization, $52 million. They spent $19 million of interest on their debt, which is up from $17 million. So their net loss is worse. It was negative $36 million, now it's negative $84 million. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates or loses from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. Their negative was pretty small in the trailing 12 months, only negative $4.2 million. They spent the most in CapEx in the trailing 12 months at $50 million. They capitalized their software development costs. That's what most of this is. Operating cash flow minus CapEx gives you your free cash flow. Since they usually have negative free cash flow, they need funds from somewhere to run their business. In 2018, they added $330 million of stock and $279 million of debt. In 2020, they added $1 billion of debt. When you raise debt or issue common stock, it's not a bad thing unless the return on the investment from that money you raised is less than the interest you're paying. To give you a simple example, if they raised $1 billion of debt and paid 4% interest on their debt, and they acquired another company, and that company only provided them 2% return on their investment, then it's a bad use of debt. But if that company provided them a 10% return on investment, then you can say that debt added value to the shareholders. Let's look at their operating cash flows from their 10Q. And this shows us the first 9 months of 2020 versus the first 9 months of 2021. And the way you calculate operating cash flow, you start with your net loss, then you have to add or subtract the non-cash items on the income statement, then adjust for changes of working capital. We start with the loss of $417 million. Then we have to add back depreciation and amortization. That's usually a big non-cash item. Even bigger for this company is stock-based compensation. This is when the company pays employees with stock. $91 million of deferred income taxes. $41 million on extinguishment of debt. This is like a penalty when you pay off debt early. It may include legal costs or prepayment penalties. Then we have to adjust for changes in working capital. They extended $19 million of credit, so that's a cash outflow. They had a cash inflow or deferred revenue. This is when their customers prepay their subscription fees, and it's carried as a liability on a balance sheet. Then each month, when the customer has access to the services, they remove the liability and book it as revenue on the income statement. So a really good sign is they have positive operating income of $111 million, which is a little less than double from last year. This is their investing and financing sections from their statement of cash flows. And it starts with CapEx. That was $5.6 million. They break out capitalized software development costs. That was $35 million. They received $50 million from the sale of securities. They received $11 million from the sale of an investment. And they acquire lots of businesses. So this year was a cash outflow of $76 million. Last year was a cash outflow of $160 million. So in their investing section, they had a cash outflow of $53 million. Last year was $177 million. In their financing section, they had a cash inflow of $23 million from stock options. Last year it was $40 million. Last year they raised $1 billion from a note. There's a lot less going on in their financing section this year as compared to last year. This is the equity section on their 9/30 balance sheet. They have $16 billion of equity. They raised $17.4 billion from selling their business, and they lost $1.4 billion from running their business. Let's look at the capital structure. $16 billion of equity, $1.3 billion of debt. They're 93% equity, 7% debt. I gave them the whack on Simply Wall Street, 5.91%, and that's a discount rate we're going to apply to the future cash flows. We estimated 7 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 7, that's $25 billion. We discounted those numbers back to today's weighted average cost of capital. We get a value of the company of $20.4 billion. We divide that by 160 million shares. And we get a calculated stock price of 128. They're trading at 82, so they're trading at a 36% discount. It's a buy according to the model. Their revenue is projected to increase 21%, so I grew at 21% for the next 7 years. That's how I got their future revenue estimates. The average company in their industry converts 13% of their revenue into free cash flow. So I multiplied their future revenue estimates by 13%. That's how I got their future free cash flows. Simply Wall Street's valuation is $219. They're saying it's 63% undervalued. 22 analysts priced this stock and the average price target is $155. The low is 110, the high is 215. This is where the stock has been trading the last 2 years. Before this crash right here, the management of the company mentioned certain milestone targets and they missed those. And that's why there was a big crash. Even if a company improves, the stock can still go down if they miss their targets. So you could view it as a buying opportunity, but the stock, as you can see, keeps coming down. The reason it went up so much is because of COVID, and they felt this company would benefit a lot from people staying at home. And it doesn't seem like COVID is going away anytime soon. But for some reason, investors have lost faith in this company. So it could be a great buying opportunity. They have a really low beta, 0.34, so the stock moves 1/3 the market. It's gone down 63% in the past 52 weeks, while the S&P is up 23%. The 52-week low is 80, the high is 308. And the stock is trading well below its 50-day and 200-day moving average. 3.5 million shares are traded each day on this stock. Of the 160 million shares outstanding, 158 million are on float, 81% are held by institutions. And it has a really high short percentage. 16% of the shares on float are shorted. Their employee count has been going up a ton, currently at 4,000. This is mainly through acquisition. If you invested $10,000 into this company when it started trading, you would have been in the red for a couple years. If you're still holding on, you'd be at $29,000 today. That's 18% annual return, which is still a great return even after the big price decline. In the past year, there's been no insider buying, but a bunch of insider selling. It seems like every insider is selling their stock. That may be another reason the stock is going down. Institutions own 84% of the stock, the general public 15%. Kathy Wood owns 10% of the stock. She's the biggest shareholder, a little over 15 million shares. And if you see a green circle, that means they increased their holdings in the past quarter. If you see a red circle, that means they decreased their holdings in the past quarter. Vanguard is the second biggest shareholder, then BlackRock. Let's look at their financial ratios. We can't look at the PE since they have negative net income. Their price to sales is 7.1. That's stock price over sales per share. That's a little better than the market average. And their price to book is really good at 0.8. That's stock price over book value per share. But they do have lots of intangible assets. Their equity is $16 billion. Their tangible equity is $1.3 billion. Let's look at their non-current assets. They have $27 million of property and equipment, $15 billion of goodwill. Goodwill is the premium you pay when you acquire another company. $1.9 billion of other intangible assets, $48 million of operating leases, and $18 million of other. They have a really high current ratio and quick ratio. They can easily cover their current liabilities with their current assets. Let's look at their current assets. $800 million of cash, $178 million of accounts receivables. This is how much other people owe them. $57 million of inventory. Their inventory is probably the telecommunication devices they sell to their clients. And $95 million of prepaid expenses. Let's look at their current liabilities. $35 million of accounts payable. This is how much TDOC owes other people. $106 million of accrued expenses. $76 million of accrued compensation. When you see accrued expenses, these are expenses the company has incurred but hasn't paid yet. $73 million of deferred revenue. This is when their customers prepay for their subscriptions. And $12 million of advances from financing companies. They had negative $54 million of free cash flow in the trailing 12 months. but they have $855 million of working capital. So it looks like they have enough funding to get through the next 12 months without needing to add any debt. The best way to look at ratios is to compare them to companies in the same industry. There are 48 companies in the same industry as TDOC, and TDOC spends a little more on CapEx than the average company. They have a really low debt to equity ratio, a lot better than average. They don't pay a dividend. They have negative free cash flow. The average is $60 million. They're the fourth largest company on this list at $13 billion market cap. The average is $3.7 billion. Their price to book is a lot better than average. We can't look at their price to earnings or price to free cash flow. Their price to sales is a little worse than average. They do bring in more revenue than the average company. And this is why people are excited about this stock. Look at their 5-year annual growth rate, 77%. That's the highest on this list. And since they have negative net income, they have negative ROA and ROE. So to summarize, I have them trading at a 36% discount. And I do feel telemedicine is the future. It's so much more convenient. And especially now with COVID, you don't want to get other people sick. So it's a lot better to stay home and talk to your doctor that way. But the $1 million question is, will this company be successful post-COVID? And if you think that is the case, then it's a great buy because the stock has come down so much. Their system benefits elderly people more because it's more difficult for them to get out of the house and get to the doctor. Some older people stop driving, so it's even more difficult to get to the doctor if you do not have a car. This stock does seem like it could be a great buy, especially if they continue growing and staying number one. Because if they ease up on their growth, then competition may take over. Since this is such a young industry, you have to really focus on growth. If it was a mature industry like an airline, then you could probably just get by on brand awareness. They seem to be really aggressive with acquisition, so they seem like they're doing a good job in that category. I rank their free cash flows 2 out of 10, their revenue 8 out of 10, and their ratio 3 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.